hello again, everyone, and welcome to Conversations with the Dean. My guest today is Lee Jones, who is the Federal Reserve Bank of Atlanta Regional Executive here in Nashville. Lee, we're delighted to have you on the campus. Welcome to Lipscomb.
Great to be here, Turney. Good to see you again, too.
Thanks for coming. Lee, we've heard a lot about the Federal Reserve during this current presidential campaign. We have candidates who think the Federal Reserve saved the economy in the recent economic crisis. We have other candidates like Ron Paul who say they would like to abolish the Federal Reserve. Why is there so much controversy about the Federal Reserve, and which side is right?
Well, you get right to the heart of the matter, don't you,
That's
Turney?
right, that's right.
Well, I can't say, which side is right, and I certainly don't want to get into a political discussion right now in the heat of the matter. And one of the reasons for that is that we like to be above the political fray. One of the reasons that we were founded and we were structured the way we were was to be independent within the government. So even though we are accountable to Congress and our oversight body, the Board of Governors in Washington, are appointed. The governors are appointed by the president and confirmed by the Senate. But once that happens, we operate pretty independently, and our goal is to do what we feel is right for the nation in the long term and not be subjected to short-term type political pressures. But you're correct. People are people, and there are divergent views out there, for sure. So, as you said, some feel that we were heroes during the crisis and came to the rescue, and there are others that are questioning all forms of government and the amount of government that's in our lives today. So,
well, let's go back to square one and let's talk about the founding of the Federal Reserve, the mission of the Federal Reserve. What is it the Federal Reserve Bank does for the viewers who may be watching who may not really understand the role of the Federal Reserve Bank?
Okay, well, the role today, and it's expanded a little bit over the years. We were established almost 100 years ago now in 1913. And interestingly, we were founded after a couple of financial panics in the late 19th century and early 20th century. And a National Monetary Commission was established to come up with a solution, and the solution they came up with was to form a central bank. And we have a number of roles. We're a pretty interesting organization that I've been with for a number of years now. But the role that most people identify with the Federal Reserve is our role in monetary policy making, in terms of the supply of money and creating a stable economy. We have a dual mandate to achieve maximum sustainable employment and price stability. We also have a number of other functions. We are one of the bank regulatory agencies. There are a number of those. Perhaps most importantly is we're responsible for supervising the largest banks, bank holding companies, come under the Fed's regulatory purview. We're also responsible for really the financial stability and credit conditions in the country, and then we're also a payments processor. We provide financial services to banks, to the government itself. In fact, most of my career was on that side of the bank, but that changed more recently. So.
Well, if the Fed is a regulator of banks, and particularly large banks, then you regulated the banks that were supposedly too big to fail. So what did that mean, that a bank was too big to fail, and what did you do to prevent those banks from failing during the recent economic crisis of 2008, 2009?
Well, and some of this is going to be my personal opinion, my personal perspective on that. So I do want to make that clear. I'm certainly not speaking, in official capacity for the Federal Reserve or the Federal Open Market Committee or anything. But I think most people would define too big to fail, and as especially following that crisis, is that the damage that would be done to the markets and to the economy by letting one of these institutions fail would be too severe to deal with. Of course, that's debatable. There are some that feel that, well, we should have let them fail. But I think the Federal Reserve, as well as Congress, felt that that shouldn't happen. So, Congress did certain things with the TARP program to help ensure liquidity and the health of banks and kind of nurse them back to health.
And this was the bailout program that we all heard so much about, the TARP program.
Right.
Yeah.
Right. Which is, become known as the bailout program. Of course, as you well know, those were loans and loans with interest that were made to those banks to strengthen them, to help capitalize them and get them through the crisis. And of course, most of that's been paid back. And of course, the Federal Reserve also took a number of very unusual steps. I imagine a lot of the economics textbooks and money and banking textbooks are being rewritten as a result of the crisis and some of the actions taken during the crisis.
Well, as I recall, in addition to the bailout funds that Congress authorized, the Federal Reserve pumped a great deal more money into the banking system. You'd probably know closer to the exact amount, but my recollection from the news headlines was that it was in excess of $1 trillion. And so another item of controversy that many people talked about and continue to talk about is that Congress, as a politically elected body, authorized the TARP funds. I think that was about $800 billion or so. But the Federal Reserve Board, not elected, actually put more money into the economy than Congress authorized. So did that turn out to be a good thing in your opinion? And do you think that was vital to saving the banking system in the United States?
Well, again, yes, in my opinion, I think it was a very good thing. Part of the advantage of being the Federal Reserve is that we're able to react quickly. As you recall, the TARP was passed by Congress, and it took some time to figure out what they needed to do. The Federal Reserve, of course, was able to act a lot quicker. What you're referring to is the authority that was given the Federal Reserve in the Federal Reserve Act. It's the Section 13(3) in response to unusual and exigent circumstances, is, I believe, the wording of that act, which gave them the authority to do exactly what they did during a liquidity crisis. And so during that time, I think in excess or around a dozen different facilities were put in place, targeted at different markets to ensure that to make loans, to ensure that corporations and banks and whatnot had the money to operate during that time. They were all very short-term loans, and again, they were above standard market rates to incentivize the users of those facilities to pay them back and get back to normal functioning as soon as that was feasible.
So just to set the record straight, the news media reports the bad news, not always the good news. Most of those loans have been repaid, if not all of those loans. Is that an accurate statement?
That is an accurate statement. Most of those, the Federal Reserve hasn't lost a cent. So, and in fact, it's a result of our expanded balance sheet. And by the way, your figure was about right. I think at the height of the crisis was about $1.5 trillion.
So almost double what was authorized by Congress through the TARP program was actually made available to the banking system through the Federal Reserve's mechanisms.
Right. And I should point out, it wasn't just the big banks too. I mean, it was hundreds of banks that took advantage of those programs. But they're all closed now, and I believe all but a small portion has all been paid back. So.
Now, another thing that the Federal Reserve does is to determine target rates for interest. And today we're in an environment in which interest rates, at least the rates to banks, is basically zero. So why is that? How can an interest rate be essentially zero? And how does the Federal Reserve make any money, I guess, would be the layman's question. And where are we headed with interest rates, in your opinion?
Okay. That being a member of the Fed, we always seem to get that question, is where are interest rates headed? And we usually hedge our answers very closely, but the Fed's gone through a lot of changes under Chairman Bernanke in recent years to enhance the transparency of what we do and what the Federal Open Market Committee specifically does. I can remember early in my career there was a big book that came out called Secrets of the Temple, and it was almost like the Wizard of Oz, what goes on behind the curtains. And particularly under Chairman Bernanke in recent years, there's been a lot more transparency, and now he's doing news conferences 4 times a year after the open market meetings, and pretty unusual. I think it was towards the end of last year or the middle of last year, the FOMC even said that based on its forecast and based on its outlook that interest rates would stay low where they are, I think to the middle of 2013, with the caveat, unless unforeseen things happen. So I think looking out, we can expect interest rates to remain very low for the foreseeable future.
Now, you mentioned monetary policy in your earlier comments, and for our viewers who may not understand what monetary policy is, and there's 2 types of economic policy. There's fiscal policy and then there's monetary policy. The Congress sets fiscal policy, which means the government's budget, what the government spends. But the Fed sets monetary policy. So what's the difference, and what does it mean for the Fed to set monetary policy?
Okay. Traditionally, monetary policy has been conducted through the interest rates that you mentioned, the federal funds rate, as well as there's a discount rate that we can lend to banks. But the Fed funds rate, the Fed sets a target, and that's the rate that banks loan to each other through the window. But it's mostly foreseen in the economy as a bellwether. So when the Fed would announce a rate change, technically speaking, it doesn't have a really large impact on just that rate itself, but it's more of a bellwether that kind of ripples through the economy, and all types of rates react to that. So if the Fed is lowering rates, then generally other rates will come down. When the Fed does an interest rate increase, then other rates in the economy tend to rise as well. So that's how the Fed controls the supply of credit or affects the supply of credit in the economy. You're exactly right in terms of government spending and taxation and policy. That's the fiscal side of the house that the Congress and the administration work together to put forth. But in terms of the credit markets and the availability of credit and money supply, that side of the house is controlled by the Federal Reserve.
When the Fed increases credit, does it have the effect of increasing the money supply? We hear a lot about the money supply. Does that mean the Fed has printing presses and actually prints currency? How does the Fed increase the money supply?
Okay, well, actually the money itself is printed by the Treasury. The Bureau of Engraving and Printing actually prints the money.
So you don't own any printing presses?
We don't actually have printing presses.
There are none in the basement of the building here in Nashville.
Right. No, we do not actually print the money, and we kind of look out for those that try to do that. But in essence, it's almost virtually the same thing. So when we go out and buy Treasury securities on the secondary market, we never buy Treasury securities directly from the Treasury. Treasury has their auctions, and then we go in the secondary market to do that, and that usually frees up funds in the economy. So in essence, it's printing money. Those balances, when we buy those securities, go out into the economy, go on the bank's books, if you will, and under normal conditions, that serves to stimulate things, and banks will make loans with that money and get it working in the economy. Of course, those transmission methods are not quite as effective as they are in normal times, again, because of the result of the the crisis. Lending standards have tightened. People are rebuilding balance sheets and businesses, and so the demand for loans as well is not, what it would normally be when the Fed takes these kinds of actions.
Let me go back to your title. You're the
Yes.
regional executive of the Federal Reserve Bank of Atlanta. Now, what is the significance of Atlanta versus the United States Federal Reserve Bank?
Okay, well, it kind of goes back to our founding again, and the intent of Congress back when we were established in 1913. So it's kind of a decentralized but somewhat centralized system. So we set up 12 regions throughout the country. So there are 12 actual reserve banks, and they are set up similar to an independent corporation, if you will. We have a board of directors in Atlanta, and the board of directors selects our chief executive, our president, and then our president, his appointment is approved by the board of governors. So we have 12 regional bank presidents that cover the United States geographically. And then you have the board of governors, and that is a federal agency. I am not a civil service employee, and the regional bank, I'm an employee of the Atlanta Regional Bank. But our oversight body, which is the Federal Reserve Board of Governors, is their civil service employees, and the 7 governors are appointed by the president, confirmed by Congress, as well as his selection to be chairman of the Federal Reserve. So the Federal Reserve Bank of Atlanta covers a lot of the Southeast. We cover the entire states of Georgia, Florida, and Alabama, and then southern Louisiana and Mississippi, and then middle and east Tennessee. And we have 5 offices in addition to Atlanta, Nashville being one of those, and my region is middle and east Tennessee. Then we have offices in Jacksonville, Miami, New Orleans, and Birmingham.
And do we have a board in Nashville? Are there boards in the offices around the Southeast?
Yes, there are. We have a 7-member board. Their primary role is to provide us with economic intelligence on what's going on in the economy, both where they are and where they live in different parts of the state, as well as the industries they represent. So yes, we do have a 7-member board of directors right here in Nashville. We meet 8 times a year.
Now, Lee, we've read in the news media here in Nashville in recent months that the Federal Reserve building in downtown Nashville is for sale. So why is the Federal Reserve exiting Nashville, or why does it appear to be exiting Nashville? Is that in fact what's happening? Or where are you moving if that building is for sale?
Okay. Yes, let me answer that question. First and foremost is we are not exiting the Nashville market. It's kind of interesting. Our branch offices, most of our employment in our branch locations throughout the Southeast, as well as the branch offices throughout the Federal Reserve System, a lot of the employment in those were hired and working in that payments function I talked about, that 4th function of the Federal Reserve. Processing and clearing checks 10, 15 years ago was our biggest area of employment in the Federal Reserve.
And we don't write checks anymore.
You're exactly right. And we also process and distribute coin and currency to the banks in our region. And as you said, we don't write checks anymore. So, boy, back when I was in college, I don't know about you, but this was in the 70s, early 70s, and there was this theory about the checkless society. And it seemed like, well, that's never going to happen. And we went through the 80s and 90s, and people were writing checks. But I think through a combination of both technology and a generational change, and people became more open to electronics, and the availability of the internet certainly was a game changer with online banking, as well as the automated clearinghouse, how most of us get our paychecks now. This is really just a pay stub because it's electronically put in the bank. So over the last 10 years, we had 12 regional offices and 25 branches. So you add those together, we had 37 locations that were processing checks throughout the country. And today we have one, and that's in Cleveland, Ohio. So our check processing operation was closed about, I'd say 5 years ago now, in Nashville. And then most recently, due to enhancements in technology and the machines that actually process currency, our cash processing function was centralized in Atlanta, and we just have a depot arrangement in Nashville that handles that distribution of coin and currency. So the armored carrier goes to Atlanta and picks up the currency that banks have ordered, and then takes back the currency that banks want to ship back. So those functions are gone now. So we have a staff now of about 9 people, down from a peak of about 240 at one time. And we don't need that big facility.
So where will you be moving? Just into office space that you lease?
Yes, that's exactly
Just like any other office?
Just like any other office.
Mm-hmm.
But we'll continue to have our board of directors, of course. Mm-hmm. We'll continue to do what I do that supports the monetary policy function, talking to business leaders in the region and visiting and making speeches and whatnot. Mm-hmm. We also have an economic education function that we do at our branch, and we have a very small team, one person with some help every now and then that teaches teachers how to teach economics in our high schools. And in Tennessee, that's a requirement in their 11th grade. And most of the teachers that do that is just one segment of the year. Most of those teachers are social studies teachers, so we help them out and give them materials, and we do seminars throughout the states to give them the materials and lesson plans and whatnot to help them teach students. And then more recently in that area is our involvement in personal finance and financial literacy. So Tennessee's kind of at the forefront in that that's going to be a requirement to graduate from high school. I believe that starts in 2013, but I'm not sure of that. And so students now in high school are going to learn about personal finance, which I think is really critical.
Sure. And
hopefully help avoid things like we've been through where people found themselves, maybe in financial instruments that, weren't their best choice. And so we have been certified, I guess is the appropriate term, to certify teachers to teach personal finance in the high school. So we also do that kind of training as well.
We're running out of time, but let me return to the function of the Fed for just a moment.
Sure.
And what I'd like to ask you to do is to help us understand a little better. We read in the news media a lot about the European banking crisis. Europe has been in crisis now for more than a year, and many people say that it, in a worst case scenario, could dramatically affect the condition of the U.S. economy. Can you help us understand in a very abbreviated version what the problem is and why that is so important to us in the United States?
Okay, and I don't think there's a clear answer. I guess to borrow the phrase of candidate Romney, economists are people too, and they have different visions and different beliefs. But yes, Europe is a very important trading partner to the United States. And interestingly, one of the positive signs of our recovery has been a growth in exports, which is very positive. So they are an important trading partner. And as we all know, the world has just got so much more interconnected these days. But I think the root of the matter is something that we should watch carefully here, because a lot of it is a sovereign debt issue. I think it goes beyond the banks, and now I'm giving you, my opinion.
Sovereign debt means the debt of a country.
Of a country.
Like our debt of the United States, but obviously Greece has debt of its own, France has debt, so that would be sovereign debt.
That would be sovereign debt.
Okay.
And those, in certain countries that we've all read about, the pigs, Portugal, Ireland, Greece, Spain, and now Italy, have been, some situations there that have come to light. But it's basically, excessive debt levels. And, when that happens, investors get nervous. Are they going to be able to service that debt? Are they on a sustainable track, or is it just going to get worse? And that causes disruptions in markets and disruptions in confidence. And as we all know, as in our own domestic situation, confidence of consumers and businesses and other governments is important in our interconnected world.
Well, we saw that recently when Congress dithered over the issue of increasing the debt ceiling. There was a decrease in our credit rating as a country for the first time. I remember when I was in graduate school working on my MBA degree, we used to call the Treasury bonds issued by the United States the risk-free investment. But there are obviously people who may not think that's true anymore, and particularly as it relates to the debt of countries in Europe. And so if a Greece, for example, were to default, how would that affect us in the United States?
Well, in the case of Greece, from what I understand and from what I've read, they have a relatively small economy. In our financial institutions here aren't very exposed to much that's going on inside of Greece. So I think the direct consequences on the U.S. economy would be minimal. Now, when we start talking about other more substantial economies and countries, and that's when that concern,
like Italy, for example, or France, perhaps, or Spain.
Yes, exactly, exactly. Then the concerns arise because those are much bigger economies, so they're dealing with that situation, and I don't have a complete understanding of it. I don't know if anybody does, and certainly the markets don't. If you just watch the market's reaction, and one day some announcement will come out of Europe, and the markets will take off, and then a week later a different announcement comes out, and the markets tank. So it's just very volatile.
Well, Lee, thank you for coming to Lipscomb today. It's been a pleasure to visit with you. I always enjoy seeing you, and thank you for your friendship with Lipscomb University. And may I also say in closing, thank you for your service to the United States and specifically to our region here in the Southeast and to Nashville.
Well, thank you so much. I'm glad to be here, and I think you do a great service with this podcast series, even because I look through your archives, and a number of the people that you've had on have been some of the people that I touch base with as part of my job to find out, kind of get that boots on the ground feel of what's going on, in the economy that I can report back to Atlanta, so the economists have other things to look at other than just that data, that they grind. They get more of that real world perspective on economic developments and more forward looking. So
Great. Well, thanks for coming.
Thank you, Attorney.
Our guest today has been Lee Jones, who's the Regional Executive for the Federal Reserve Bank of Atlanta. Thanks for joining us on Conversations with the Dean. We'll look forward to seeing you again soon.